And we'll do this with what we'll call a one-period model. So we'd have a cash flow at date 0 and then a cash flow at date 1. That's all we need to be able to get much of the machinery in place that we'll use down the road. So let's suppose that you're going to make an investment into an account today at date 0 of $10,000. And that account will offer you an interest rate of, say, R%. The question then would be, what should you expect to have in the account at date 1 if you invest $10,000 at date 0 if the interest rate is R%? The purpose of our lesson today is to derive a concise formula that will allow us to calculate the sum of the present value of a series of constant cash flows that are discounted at a constant rate and terminate after T years. Suppose that you're considering the purchase of a piece of equipment that will cost $1 million today and produce cash inflows of $200,000 per year for each of 10 years. If the interest rate is 10%, what is the net present value of the investment? To calculate the NPV longhand, we would need to discount each of the 10 cash flows back the appropriate number of years at the 10% annual interest rate to arrive at the present value, and then subtract the $1 million to arrive at the NPV. For this example, the net present value is $228,913.
Before we actually look at financial statements, it's important for us to understand who prepares and makes the rules. We actually have a name for the rules. The name for the rules is Generally Accepted Accounting Principles, which we typically just refer to as GAAP. GAAP stands for the standards and practices that the firm must follow when they prepare these financial statements for external users, and they're based on both theoretical and practical considerations. The first step that I usually take is, let's just look at the trend in net sales or revenues. We see in this case that revenues increased every year, clearly better than the alternative. The second step is I want to start looking at margins on the income statement. What is a margin? Well, a margin is nothing more than the difference between revenue and some class of expenses.